Hey, it's Zach with Us versus Herd, coming back today with another video. So I want to talk about some strategies that we use when we trade options. More specifically, I want to try to simplify this really technical term of selling premium. Basically, when I was first starting to trade options, there were a lot of technical terms that were really hard to understand at first, and they didn't really make a lot of sense. So I'm trying to endeavor to try to simplify it in a way that I would have wanted it explained to me when I first started. So I'm going to put it into some context as well and what it looks like when we put it together. If you guys like the video, just remember to like and subscribe down below and comment if you have any questions. We will answer your questions. But yes, please don't forget to subscribe, and I'm going to go into the video now. So basically, I'm going to describe what premium is. So this is the technical term. So what is premium? The total price of an option contract. The premium is paid to the seller of the option is quoted on the per share basis. So that basically means that this is how much it's going to cost since one option represents 100 shares, it'll say that it's worth 87.5 shares, which in turn would be 87.50. But actually not entirely correct. It would be 87.50. Okay, so this is the term. It says premium is not refundable, nor does it ever come back to the option buyer in any way. So basically that means like you can never get that back technically though if you buy the premium outright, and it does come back to you if you profit, if the stock price does go up or down depending on what you bought. But it's not refundable, meaning you'll never get that actual amount in total back from the seller. So in some strategies that layout buying and selling options on the same stock, the selling portion of the theory is to collect the premium to defray that's just a long way of saying hedge it, basically, by saying if you don't know if it's going to go up or down, you buy one of each side, and whichever side one will expire worthless and the other side you can profit on. So that's the technical term I found on the street.com. So I don't really necessarily like it at all. It's kind of confusing. It doesn't get to the heart of it. So for my translation here is much easier. So for me, premium is the amount of money paid for a contract. So one contract is basically when on an option, if you buy a call or put, you can buy one or two or how many contracts you like. So premium is the amount of money paid for a contract. It's kind of like, for example, if you're going to get health insurance coverage, and you have a premium that you pay every single month, and then they offer you health coverage. So you pay that amount per month, and then you get access to health coverage. That's basically what this is like. So if you buy a call, for example, you are buying premium. So if you're purchasing a call or a put, that is premium buying. If you are selling calls, you are selling premium, meaning someone is purchasing it from you. So those are the two sides of this whole thing. Buying, you buy from the seller, obviously, and seller, you're selling it to someone. So when you're buying an option from somebody, or if you're buying a call or a put, then it will be a debit. It will be a debit because it's your own money, and when you are selling it, it will be a credit because you're getting the money up front. So let me explain. Let me simplify selling premium, since this is one of the best ways that we make money on options is selling premium. So I'll look at it. We'll also talk about buying. So when you buy premium, your goal is to sell the option at a more expensive price than you paid. So you want to buy it, and then you want the price of the option to get more expensive. That way you can sell it back and make the profit. For example, that's like buying a product or manufacturing a product for cheap and selling it to make more profit. So like Walmart, if they get their stuff manufactured in China for cheap, they can sell it back in the United States for more money and make profit. It's the same idea. You buy an option, it gets more expensive, and you sell it. So basically what it means is when you buy that option, it's giving you the right to buy those 100 shares at the price that you paid. So if you buy it for 80 cents and it goes down, it gets more expensive, it goes to $1, then you're netting a 20-cent profit, or however much the cost of the option is 20 cents. Not actually 20 cents, depending on how much you put in. Basically, that's what the idea is when you're buying premium. So if you buy a call, you'd want the stock to go up, and if you buy a put, you want the stock to go down. this is basically buying a premium is the most simple thing. It's pretty comparable to buying and selling stock. You want to buy low and sell high. It's basically that's the same idea. Now, when you sell premium, this is how you make most of our money. So this is probably the most important thing to be thinking about when you're trading options is how to sell premium. What does it mean to sell premium, and why is it effective? So when you sell premium, you are selling that contract to that buyer. So you can sell a call or put to someone who's buying the option. You are on the other side of the deal from who is buying the premium. So when you sell premium, the person who bought them pays you up front. That's why it's called a credit. So when you sell an option, you're getting a credit. So that money comes to you up front. All of the entire worth of that option comes to you up front. Basically, you get a credit and the full amount is given to you up front. So when you sell an option, it gives you the right to buy back the option at a lower price. So if you're selling it at $1 and later on the cost goes down to 50 or 40 cents, then you had the ability to buy it back at the lower price. That's basically what it comes down to. So when you sell an option, it gives you the right to buy it back at the option at a lower price. Your goal is to buy it back at a lower price than you paid for it, obviously. So that's how you profit. If you paid $1 and the price goes down to 50, that's 50 cents. That's a 50-cent profit right there. Just using numbers for the sake of teaching. So you also are able to profit 2 out of 3 ways rather than 1 out of 3 ways. So for example, if you sell a put, you're expecting the stock to go up. However, if it goes down, you lose money. But if it stays the same, you will also make money, and generally it's closer to the expiration. So what that means is there's 3 ways to make money. One way is if the stock goes the way you want it to. So for example, if you sold a call, that means you want it to go down. If it goes down, you make money. If it stays the same, you make money. The only way you don't make money is the other way, is if it goes against you, so meaning up. Same thing if you were selling a put. If you were selling a put, you're expecting the stock to go up, you make money 2 out of 3 ways. If it goes up or if it stays the same. But if it goes down, you lose money. That's what I mean by the 2 out of 3 ways or 1 out of 3. So if you buy premium, you can only win 1 out of 3 ways if it goes your way. You don't win any other way. So you don't get the third option of, since you didn't sell premium, you bought it, it will expire worthless. And when it expires worthless, the person who sold it to you will take that money. And that's why it's generally closer to the day of expiration. That's when the theta is working for you the most. We'll get into theta in a different video, but basically I wanted to simplify these terms and what it meant to sell premium. If you found this video helpful, leave some comments below. Do not forget to subscribe. We do come up with videos pretty much every day. We do try to endeavor to do that, and we are trying to teach as much as we can, as well as give you our live trades and put down some cool things. So like and leave some questions below. We'll answer them, and we'll see you next time. Just remember, it's us versus herd, so join us.